Welcome to Chapter 2 of Accounting 1. We're going to look at debits and credits today and doing journal entries. Journal entries are the foundation of double entry accounting. So, very important chapter, and it's very important that you get these concepts in this chapter, as we're going to be using them through this semester and the next, and for the rest of your life if you are an accounting major. So very important material in this chapter. Okay, so what is an account? Well, we actually used some accounts in Chapter 1 when we looked at net solutions. He had a cash account, supplies, land, a drawing account for his withdrawals, accounts payable. So he had several accounts. Even fees earned was his revenue account. So these are separate records that show increases and decreases in each element or each type of thing involved in their accounting equation. So we will have elements of the accounting equation: assets, liabilities, and equity. And those are the types of accounts. Under those categories, we will have several accounts. You could have 1,000 different assets. Some of these, huge corporations may have hundreds and hundreds of asset accounts. So we obviously do it on a very small scale while we're learning in this class. So assets, we'll have a list of assets: cash, supplies, land, equipment, machinery, vehicles, buildings, you name it. Those resources are assets. The liabilities: accounts payable, wages payable, unearned fees. If you've been paid in advance for something, that would be a liability. And in the equity, we would have the capital and drawing accounts. A T account is a shorthand way of depicting an account. And can you guess? It looks like that. So we're going to say this is a cash account. And we're going to put all increases over here and all decreases over here. And we're going to get a balance at the bottom. If we add up all the pluses, subtract the minuses, and we get $1,000, that's what we would put here. If we add up all the pluses and subtract the minuses and have a negative number, we would put it here. That would be bad though, right? If you had more subtractions from the cash account than you had deposits, that would mean you're overdrawn. It can happen though. So you could be overdrawn, and this would then change from not being an asset, but it would be a liability because you would actually owe the bank that money back. But we're not going to deal with that in this class, but we're going to always have a positive balance on all of our examples. Okay, debits are on the left, so this is the debit side. And credits are on the right. That's the credit side. So when we say we debit an account, we put it on the left side of the T account. If we say we credit that account, we would enter it on the right side of the T account. And you'll see when we look at a journal template, what a journal looks like where we do our journal entries, you'll see there's two columns. There's a debit column and a credit column. A ledger is a group of accounts, so it's just a listing of all the accounts and their T accounts. So it's like a summary of all the reports, all the ins and outs of each account. And a chart of accounts is just the account names. So it's just a list of account names that have been created for the company, and you can use that to choose from the accounts that you're going to do your journal entries, use for your journal entries. Okay, so we've talked about all these asset groups before. Assets, liabilities, equity, revenues, and expenses. And these are their own account groups. They do net together to make net income, which eventually goes into equity. So when we do our balance sheet, we have assets equals liabilities plus equity, and that equity number, if you think back, that equity number comes from the statement of owner's equity. The statement of owner's equity beginning capital plus investments minus drawing plus net income gives you ending capital. So that number is the same as the owner's equity listed on the balance sheet. So this net income is reflected in this number. So that's why we don't have to list those on the balance sheet as well. They are already reflected. The net amount, the total, is already in the equity amount on the balance sheet. Those are still account groups though. We do have revenue accounts, sales or sales commissions or fees earned. It could be even interest revenue. If you have money in the bank and you earn it from the bank, that money is earned, it's revenue. So we would have an account for interest. Expenses, we could have hundreds of expense accounts. Wages, utilities, rent, postage, gas, taxes, insurance, all types of expense accounts. So they are also an account group. So double entry accounting is what we're doing. It's based on the accounting equation, and we all know that by now. Assets equals liabilities plus equity. Every transaction is stated in terms of the accounting equation as far as increases or decreases. And every transaction affects at least two accounts. You'll have at least one debit and one credit. At least. You could have 4 debits and 10 credits. Not in this class, but in the real world you could. But in this class we're going to have generally one debit and one credit, and then we may occasionally have one debit and 3 credits or something like that. Debits and credits will always balance, so they'll always equal, no matter if you had 2 debits and 4 credits. The total of debits, total credits, always equal. Okay? Total debits will always equal total credits. So we have specific rules based on the type of account. If it's an asset, liability, equity, revenue, or expense. Okay, they each have, or there's 2 sets of rules, and then each account type falls into those rules. So we've got this mirror image approach, and this is what I generally teach, a way for y'all to remember this. So we've got the accounting equation at the top, assets equals liabilities plus equity, and then we have these little T accounts under each side of the accounting equation. Debit and credit, and any assets are increased with a debit. They're decreased with a credit. Liability and equity accounts, decreased with a debit, increased with a credit. So this opposite, that's why it's called mirror image, because you basically have this imaginary line here, and as you cross the equal sign, it flip-flops. So we also have assets, expenses, drawing. Those all follow this pattern over here. So any asset account, cash, supplies, land, accounts receivable, inventory, billings, machinery, all those asset accounts follow this same pattern. If we purchase a building, we're going to debit the building account because that would be an increase. If we paid cash for it, we would credit the cash account because that would be a decrease. So we would have a plus and a minus both on this side of the equation. Our equation would still balance. We're basically swapping one asset for another. And our debit would be to building, credit would be to cash. Expenses are also follow this pattern. So wages expense, if we pay our employees, we would debit wages expense because we're adding to the amount of expense we've incurred. If we pay out cash, we credit cash because that would be a decrease in cash. And the drawing account, that's the owner's withdrawals, also follows that pattern. We would debit the owner's drawing account if they withdrew money, keep up with the amount that they have withdrawn, and credit cash for the withdrawal. One way to remember this is AED is after eating dinner, LRC, Let's Read Comics. That's obviously been around for a while because nobody reads comics anymore. But we've got assets, liabilities, or assets, expense, drawing, liabilities, revenue, capital. After eating dinner, let's read comics. So that's just another way to remember what's on each side. So any liability accounts, accounts payable, wages payable, unearned fees, all follow this pattern here. And they are increased with a credit instead of a debit. Revenues also follow this pattern. The capital account follows this pattern as well. And I threw in accumulated depreciation, which we haven't gotten to yet. I think we do that in chapter 3. It's when we start looking at that. But that would follow that pattern as well. Okay, so what you'll need to do is go ahead and, if you haven't already, created or write this down on your notebook somewhere. You'll use these rules every class. So if I'm going to write this again, and I do the T accounts underneath them. You can either do like a plus sign and a minus sign, minus and plus, or you can do up and down, down and up. And this is debit and credit side. Debit is always on the left. Debit and credit. And then after eating dinner, let's read comics. So assets follow this pattern, expenses and the drawing. Liabilities, revenue, and the capital account. You should be able to draw that without, you need to memorize that, okay? Because we're going to be using this every class. Another way you could do it, if you don't want to use the T accounts, you could do your accounting equation and just put increase with debit, decrease with credit, decrease with debit, increase with credit. So you could just list it like that, so that if you had an asset account you needed to subtract from, like cash, maybe you paid out cash for something, you would know to credit that. Of course, you then have to know that credit is the right side. So if you have that down pat, you could use this method down here. And then liabilities and equity, if you have a liability that you're paying off. Let's say you're paying off a credit card. Well, then you would debit that liability to bring it down. If you were paying cash, you would then credit cash. So there's your one debit and one credit. So we're going to do a lot of these and go through several examples, hopefully to get you very well versed in journal entries. So the 3-step process that you take when you're doing journal entries, always go in this order, and you'll hear me refer to this a lot. First thing you do, which accounts? Determine which accounts are affected. Well, if you purchased land and paid cash, land and cash. Those are your 2 accounts. You can use your chart of accounts to figure out which account name, which names you need to use. Okay, the second thing is you're going to decide whether they go up or down. Okay, up or down. So let's go with the land for cash example. If you purchase land for cash, which way would land go? It would go up. If you paid cash, which way does cash go? It goes down. So then you would translate that into a debit or credit. All right, so if we look at our rules, okay, land we said went up, there's a debit. Cash went down, that's a credit because they're both assets. They're both under the asset heading. If you break it down into this 3-step process, it makes it a little bit easier. You're not just overwhelmed all at once. So if you take it one step at a time, it's the best way to do it. Which accounts, up or down, debit or credit? After we've done journal entries, we then post to the T accounts because we got to keep those accounts up to date with what we've done to them. So in manual bookkeeping, which not many businesses do manually anymore, they use computers, but in the brain of the computer, that's what it's doing for you. The computer is automatically posting from that journal entry to the T account. In this class, we don't use computers. We are going to do manual. So you'll be posting to T accounts. And T account, again, is a shorthand version of a ledger. So it's the same thing as a ledger, but it's a shorthand version, and we use that in class because we don't have a binder full of ledgers for every account that we use. So make sure that you post on the correct side of the T account. If you debited the account, you're going to put it on the left side of the T account. If you credited the account, put it on the right side of the T account. And then after you've posted all journal entries into the ledger, you'll then get a balance for each account. Those balances are the numbers that we use for our financial statements. We take the balances from all of our accounts and we put them in a trial balance. And this is going to verify the quality of debits and credits and help us discover errors. So our trial balance will balance at the end. After we list all of our account names and their balances, we add up the debit column, add up the credit column, and we will balance. So let's look at this example. This is actually, if you're using the 24th edition of the book, this is problem 2.2a on page 91. But I put it on the video, on the PowerPoint, so that everybody can see the part of the problem, and even if you don't have a book. Faith Schultz, on October 1st, Faith Schultz established Heavenly Realty, which she completed the following transactions during the month. So we're given a list of things that happened in this company for the month. We're asked to journalize these entries using the following accounts. So this is a chart of accounts. So we're going to use this when we're determining that first question, which accounts. We're going to pick from this list. Then ask us to prepare T accounts and post the journal entries to these accounts. So we'll do that after we do the journal entries. And there's some other questions at the bottom that we'll address after we have some data to look at. Okay, this is a journal template. Sometimes you may have seen a journal before that a lot of times are green pages with lots of lines on them. So you may have seen someone using those before, especially if they do manual accounting. But this is just a journal template that I made up on Excel, and it's got a date column, description. This is going to be your account name, and debit or credit. We got debits on the left, credits on the right. And post reference, that's for a check mark if you've posted it to the T account. So when we post them, we can either check mark or put the page number of the ledger that we used. Okay, so remember our 3 steps. Which accounts, up or down, debit or credit. Okay, and you also should have your little mirror image T account thing handy, because we will look at those after eating dinner. Let's read comics. So assets, expense, drawing, liability, revenue, capital. Okay, so we can refer to that as we're doing these journal entries. Okay, the first transaction, Faith transferred cash from a personal bank account to an account to be used for the business, $20,000. First Question, which accounts? She transferred cash to the business. Cash goes up, capital goes up. So cash and capital are the two accounts. They both go up. Cash is an asset. To make an asset go up, we debit. Capital is an equity account. To make it go up, we credit. So there's our journal entry, debit and credit. And this is A, transaction A. Whoops. Getting ahead of myself here. And what was her name? Schultz, Faith. Capital. Okay, so there's our journal entry. Debit cash for $20,000, credit capital for $20,000. This makes cash go up, and this makes capital go up. Second thing that happened, she paid rent on office and equipment for the month. So which accounts? This is rent, so we're going to use rent expense. And she paid. See the word paid? That generally means cash. So rent expense and cash. Okay, which way did rent expense go? It went up. Expenses to go up, that would be a debit. So rent expense went up. Cash went down. She paid out cash. Cash went down with a credit. And that was $37.50. Okay, so we've got a debit to rent expense, credit to cash. Third one, purchase supplies on account, $1,100. Okay, if she purchased supplies, that means she gained them, she received them. So supplies, which is an asset, goes up. So there's your debit. And on account means she didn't pay for them yet. She has an account with that company and she has to pay it. So that's going to be a payable, a liability, accounts payable, a credit because it goes up. So accounts payable is our credit, and it was $1,100. Okay, let me take a step back for a second and give you another way that you may remember or figure out how to do these. I had a student one class that he raised his hand and he said, let me get this straight. The top number, the debit, is what you got, and the credit is how you got it. And I thought for a minute, and sure enough, it works if you think that way. So either what you got or what you paid for is the debit, and how you got it or how you paid for it is the credit. So the debit is what you got or what you have. The credit is how you got it. So looking back at these three journal entries here, the first one, what did we get? We got cash. How did we get it? From the owner. The second one, what did we get or what did we pay? Rent. How did we do it? With cash. The third one, what did we get? Supplies. How did we pay it? Debt. We put it on account. So if you get stumped, you could think of it that way. What you got, how you got it. Letter D, we paid the creditor on account. So some of those supplies that we just purchased, we're now making a payment of $400. Okay, paid means cash was paid out. That's going to be a credit to cash for $400. And if we paid the debt, that means we paid down some accounts payable. That debit to accounts payable makes it go down. All All right, transaction E. Earned sales commissions receiving cash $16,750. Okay, which accounts? Sales commissions and cash. Up or down? Sales commissions goes up, cash also goes up. All right, so sales commissions, we want revenue to go up, that's a credit. So this is transaction E, sales commissions. And it was $16,750. And cash, to make cash go up, we will debit. So cash, $16,750. This is what you got. This is how you got it. You got cash from making a sale. And you've probably noticed that I put the debit first in each of these and the credit second. Kind of indented a little bit. Makes it easier to read. The next transaction, paid automobile expenses for the month, $1,000, and miscellaneous expenses of $700. Well, we've got automobile expense account, miscellaneous expense account. So which accounts are affected? We've got automobile, miscellaneous, and cash, because we paid cash. So we've got 3 accounts in this example. Auto expense and miscellaneous expense go up. Expenses are over here. They follow this pattern. We're going to increase with a debit. So auto expense and miscellaneous expense, both going up. This one was $1,000 and miscellaneous was $700. We paid cash, which is a credit, and we can put the total there. Notice that our debits equal $1,700, our credits equal $1,700. One other thing I want to, another little trick. If you memorize the cash rules for cash, then you've got half of just about every one of these, except C. If you memorize that cash is increased with a debit, and that it's decreased with a credit, you really don't have to know any of the other rules. You should, but if you get stuck, it's a good thing to fall back on. So let's take that last one for example. You can't remember what expenses are, like how, as far as what rules they follow. So if you can't remember that, well, at least you know that cash is decreased with a credit. You know that to pay out cash, you credit cash. So the debits have to be expenses. The debit has to be to an expense because the credit is to cash. So if you remember, these rules, you'll get half of every one of these, except the one the C that was on credit. So keep that in mind. Also, I know you're in the back of your head saying, but wait a minute, when I go to the store and I swipe my debit card, it subtracts from my account. So wouldn't I debit to subtract from cash? No. Okay, we are doing accounts for the books. So it's kind of flip-flopped because really the bank is it's flip-flop. Bank bookkeeping is different. And you say, well, when I deposit, they credit my account. They put it into my account. That's an increase. But no, don't think of it that way. Cash is decreased with a credit in the books, okay? So some people get thoroughly confused with that. All right, letter G, paid office salaries of $2,150. Back to the accounts. Which accounts? We've got office salaries expense and cash. Okay, office salaries go up. We incurred an expense, keeping up with the amount that we have incurred, and cash goes down. So there's a debit, the increase in expense, and the credit is the decrease in cash. So we've got office salaries of $2,150 and a credit to cash. Okay, next, determine the cost of supplies used was $600. So cost of supplies used was $600. Okay, how many supplies did we have? Well, we had 1,100 and we used 600. So we had to subtract from the supplies account $600. So supplies is an asset, and to subtract from an asset, we credit. So we're going to have a credit to supplies for 600. Our debit is going to be to supplies expense, which is increased with the debit. The expense account is the amount that we have used. The supplies account is the asset of what we have left. Okay, so that's another area that can be confusing for students. Supplies expense is used. We've incurred that, we've used it. We're going to subtract that expense from revenues to get net income. We've used that amount. Supplies are what we have remaining or left. They're going to go on the balance sheet. They're an asset. It goes on the balance sheet under assets because we own that. We will use it later. Okay, the last one, Faith withdrew cash for personal use of $1,000. So our two accounts, we're going to have the drawing account and cash. And drawing goes up. We're keeping up with the amount that she withdrew. And drawing, the D is the D in dinner, after eating dinner, so it's on the left side of the accounting equation. It follows that pattern. Debited for $1,000, that will increase the drawing account. And cash came out, so we withdraw cash of $1,000. Okay, another observation looking at this now that we have the journal completed. Notice that expenses are only debited. Every one of them. We never credited an expense. Cash, we debit, credit, debit, credit. Cash comes in and out. Accounts payable, we debited and credited. We incurred it and then we paid it off, accounts payable. But expenses are not. So expenses are, the only time you ever credit an expense account is when you close the expense account out. We do that in chapter 4. So, and it'll be one entry, and you close it out to 0 to start fresh for the new accounting period. So, rent expense, very rarely ever credited. Okay, just a little thing to keep in mind. Okay, so we've journalized the entries. Now we're asked to prepare T accounts and post the journal entries to the accounts. Okay, so we need to make some T accounts. We need 11 of them. We'll do one little one down here. Alright, so cash needs to have a lot of room because we use that almost every transaction. Then we have accounts payable. I'm just taking these from the chart of accounts. We have the capital account. And then we have the drawing account. We've got sales, commissions, rent expense, salary, office salary expense, auto expense, supplies expense, and miscellaneous expense. And I forgot supplies, the asset supplies. Okay. I'm going to go through here and just put the assets. I'm going to make, let's put assets. Let's just do red. This is an asset. This is an asset. Cash and supplies are both assets. They follow a pattern of increase with a debit, decrease with a credit. Increase with a debit, decrease with a credit. And you wouldn't do this every time you make T accounts. I'm just doing it since we're just first learning this. On the left side of the accounting equation, we also have expenses and drawing for after eating dinner, AED. The expenses, this is expense, 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 and then the drawing. So we've got our AED, after eating dinner. They all follow the same pattern. Okay, increase with a debit, decrease with a credit. All right, so now let me do the right side of the accounting equation, liabilities and equity. We have LRC, liabilities, revenue, and capital. Let's read comics. So we've got liability and accounts payable, revenue, so our sales commissions, and capital, it's a capital account. They follow the opposite pattern. Okay? The reason that this works, the reason that double entry accounting works is because everything on the left side of the equation are resources or things that are used by the business, assets, expenses. Everything on the right side of the equation are the way that you get those. You either borrow the money, or your owner invests the money, or it's from some leftover net income from a previous period. So we're accounting for everything we own. We're saying, how did you get that? Did you borrow the money? Did the owner invest it? Did it come from net income from a previous period? Where did that come from? So we can't just have things show up out of thin air. We got to say where we got it. We got to prove. We got to account for that. So that's why this works, because everything in red on this screen are things that we use, things that we own. And everything in green are the places that we got it from. We either got it from liabilities, capital, or revenue from a previous period. Okay, so that's kind of the way that it all works. So what we need to do is go back to our journal entries and take these numbers and post them into the T accounts for each account. So cash is debited for $20,000 in the first one. Capital is credited for $20,000. So we're going to say cash debit $20,000. Capital credit $20,000. And we can put an A beside it so that we know where that came from. Over here we can say, yep, we posted it. So post reference, you can say, yep, we posted it. We only have one page of T accounts. We could put page number 1 on that, but you know, if we had a binder full of ledgers like we would if we were doing this in the real world, then we could put page 37 or page 410, whatever page that is posted into the T account. Next, rent expense and cash for $37.50. Rent expense, debit, cash, credit, $37.50, and this is B. Supplies and accounts payable, $1,100. So supplies is debited, $1,100. Accounts payable, credited, $1,100. Okay. Make sure you put it on the correct side. Okay, so we did those. Okay, accounts payable and cash for $400. So accounts payable is debited $400. And cash is credited $400. All right, next, cash and sales commissions, $16,750. So cash, debit, $16,750. We increased cash. And sales commission credited $16,750. We made money. We can keep up with the amount that we've earned. That increases sales commissions. All right, next we have auto miscellaneous expense and cash for $1,700 and $1,700. So auto expense $1,000, miscellaneous expense $700, both debits, and then we have cash $1,700 as a credit. Just moving them over. All right, now office salary expense $2,150, cash $2,150, $2,150, and cash credit $2,150. All right, supplies expense and supplies for $600. Supplies expense and supplies. Okay. Check that. Whoops, put that one in the wrong spot, didn't I? Check those off. And then drawing and cash for $1,000. Let's do those real quick. Whoops. Drawing for $1,000 and cash for $1,000. Okay. So we've got them all posted. Now we need to get totals. To get totals in T accounts, you add up the plus side and you subtract the minus side. So for the red ones that we have on here, assets, expenses, and drawing, we'll add up the debits, subtract the credits. Now some of these don't need balances. If there's just one total, that is the balance. So these just have one. All these here. Okay. We need to get a total for this one, that one, and cash. Okay, so for cash, let's punch these in. $20,000 plus $16,750. Minus $3,750, minus $400, minus $1,700, minus $2,150, minus $1,000. Okay. I want to double check my numbers here. Okay, $27,750. And notice I put it on the debit side because it was positive. We have more on this side than we do on the right side. All right, for accounts payable, we add up the positive side, $1,100, subtract the $400. So now we have a balance of $700. Okay, we still owe $700. And the only other one that needs a balance is supplies. We add up the positive of $1,100 minus $600, and we get $500 balance. Okay, so those are all the balances. They ask us to prepare an unadjusted trial balance as of October 31st, 2012. That was the next, well, I guess I didn't put it on here. But yeah, we need to do a trial balance. So, trial balance is going to be similar to a financial statement as far as the heading goes. So let's do that. All right, we're going to put the name of the company up top. Heavenly Realty. And then unadjusted, it's going to be called unadjusted trial balance. We'll do adjusting entries in chapter 3, and then we can call it an adjusted trial balance. And this is October, I guess this will be the last of the month, last day. All right, we're going to list these in order of assets, liabilities, equity, revenues, expense. That's the order that we're going to list these. So we're going to list assets first, cash, supplies. Those were our only two assets. Okay, then we'll have liabilities, accounts payable. So only liability. Our equity account is the capital, right? The capital. And then we'll also put her drawing, because that is an equity account, although it follows the pattern that an asset does. It's on the left side. It's one of those exceptions to the rules. So we've got a capital and drawing. Then the revenue account is sales commissions. Then we have our expenses. And we're going to list those largest to smallest, with miscellaneous being last. So our largest expense is rent, then salaries, then auto, then supplies, then miscellaneous. So rent, then office salaries, auto, supplies expense, and miscellaneous expense. All right, and we're going to have like a debit column and a credit column, because if it's a debit balance, it'll go on the left. If it's a credit balance, it'll go on the right. We would generally do this in like Excel or something that would be a little bit neater than this. Accountants need to be neat and precise, but this is what we got to work with. So the balance for cash is $27,750, and it's a debit. So I'm going to put it there. Supplies, balance is $500, also debit. Accounts payable, $700, credit balance. Capital, $20,000, credit balance. Whoops, drawing, $1,000, debit balance. Sales commissions, $16,750, credit balance. Rent expense, $37.50, debit balance. Office salaries expense, $21.50. Auto expense, $1,000. Supplies expense, $600. And miscellaneous, $700. Okay, get our totals. Okay, and we balance $37,450. That number does not really mean anything. We just want to verify that we have put in the same amount of debits as we have credits. So the $37,450 is not a significant number. We want to make sure that the debits equal credits, and they do. They balance. So that's our trial balance. Okay, they ask us to determine the following. Total revenue recorded in the ledger. Well, that was the balance in sales commissions. That was the only revenue account we had. And that was, if we look on here, $16,750. So our total revenues were $16,750. Okay, now it asks us total expenses. Well, we would just need to add up those expense totals on here. Got 3750 plus 2150, 1,000, 600, and 700. So 8,200. What is net income? Well, that's revenues minus expenses, so we'd subtract those two. You get 8,550. Now we could do financial statements with these numbers. We would generally do a couple more steps before we do financials, like adjusting entries. But we could take revenues of 16,750 minus expenses, get the 8,550 of net income, do a statement of owner's equity, have beginning capital of 0, additional investment of 20, minus the 1,000 plus the 8,550. That would give us total owner's equity or ending owner's equity. Then we can do a balance sheet, assets on one side, liabilities of 700 plus what we came up with on the statement of owner's equity. And our balance sheet would balance as well. So we could do financial statements for this set of this problem. That's why they ask you this, just to kind of keep you from doing, having to do the income statement. And then they ask you the increase or decrease in owner's equity. That's basically the statement of owner's equity. You're going to have the 20,000 investment minus 1,000 for her withdrawal plus 8,550 for net income. So minus 1,000 plus 8,550. 27,550. Okay. All right. If you have questions, you can post them to the discussion board. And as always, you can email me or give me a call in my office. I'll see you back for chapter 3.